There's a man named Daniel in Charlotte who earns $107,000 a year. He has banked at the same institution since he was 19 years old. He has his checking account there, his savings account there, his car loan there, and last year he took out a home equity line of credit there too. He considers himself a loyal customer. He gets a birthday email from them every year. What Daniel does not know is that in the last 12 months alone, his bank has extracted an estimated $11,400 from him through interest charges, below-market deposit rates, account fees, and loan origination costs, on money that was his to begin with. He handed them his paycheck. They handed him a fraction of it back in the form of financial services. The rest funded quarterly earnings that his bank reported to shareholders with considerable pride. Daniel is not a customer in the way he thinks he is. He is the product. He is the inventory. And the relationship he has spent 26 years building is worth exactly as much as it is worth to them, which is not what he thinks it is. The structure of this arrangement is more deliberate than most people realize, and the numbers behind it are staggering. According to the Federal Deposit Insurance Corporation, the 6 largest U.S. banks, J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup, U.S. Bancorp, and Truist, collectively held $9.6 trillion in deposits as of late 2025. The average interest rate paid on those deposits sits at approximately 0.46% APY, according to the FDIC national average. Meanwhile, the Federal Reserve's data shows those same institutions deploying that capital into mortgages, auto loans, credit cards, and commercial lending at average rates between 7 and 24%, depending on product category. The spread between what they pay depositors and what they earn on depositor money is the single largest profit engine in American banking. In 2024 alone, the 4 largest U.S. banks reported a combined net interest income, the formal name for this spread, of over $220 billion. That $220 billion came from somewhere. It came from the accounts of people who thought they were storing their money safely and were, in financial terms, working a second job for their bank without compensation, benefits, or a choice in the matter. Here is the reframe that fundamentally changes how you interact with every financial institution for the rest of your life. Banks do not exist to help you manage money. They exist to acquire cheap capital, your deposits, and deploy it at a profit. Every product they offer, every branch they staff, every app they build, and every rewards program they advertise is designed around one goal: keeping as much of your money in their institution for as long as possible at the lowest possible cost to them. Understanding that does not make banks evil. It makes them businesses. What it does is clarify that your financial interests and their financial interests are structurally opposite in almost every transaction you complete together. And navigating that opposition requires a completely different operating model than most people use. The trap is not a single product or a single fee. The trap is an ecosystem, and it is engineered with a sophistication most people never fully appreciate until they map it out. Let me walk you through exactly how it operates, because the mechanism is more elegant than it first appears. It starts with the checking account. The checking account is the anchor product, the relationship foundation that every bank prioritizes acquiring above everything else. It is worth almost nothing to you as a financial instrument. It earns 0 or near 0 interest. It charges monthly maintenance fees that average $15.50 nationally, according to Bankrate's 2025 survey, unless you maintain a minimum balance or meet a direct deposit requirement, both of which are behavioral leashes designed to keep your money stationary. What it is worth to the bank is enormous. Once your paycheck flows into their checking account, you are enrolled in their ecosystem. Your bills autopay from there. Your debit card is linked to that account. Your mobile app relationship is built around it. The switching cost, the friction of moving everything to a new institution, becomes a psychological and logistical barrier that most people never clear. The bank counts on this. Internal retention data at major institutions consistently shows that checking account customers stay an average of 14 to 17 years. Not because the product is exceptional, because leaving feels like effort and staying feels like inertia. From the checking account, the relationship expands. The bank offers you a savings account, conveniently linked, conveniently visible in the same app, earning that 0.46% average rate. They offer you a credit card with points and rewards that feel like a gift and are, in aggregate, funded by the merchant fees and interest payments of other cardholders in ways that net out in the bank's favor, regardless of whether you pay in full each month. They offer you an auto loan when your car payment comes due, priced at a rate that carries a markup above what your credit score would command at a credit union or online lender. A spread the dealer finance office and the bank split as referral compensation. They offer you a mortgage, a HELOC, a personal loan. Every product cross-sold to an existing checking account customer costs the bank roughly 60% less to acquire than a new customer, according to internal industry data cited in a 2024 Bain & Company report on retail banking economics. That is why the banker always asks what else they can help with. The question is not customer service, it is margin expansion. Now here is where it becomes personal, because this is not a problem that lives only in the bank's favor. It lives in yours every single month, in the form of concrete, measurable dollar amounts that never appear on a single line item. Consider a woman named Angela. She is 38, earns $84,000, and has the following relationship with her primary bank. A checking account with an average balance of $6,400, a savings account with $22,000, an auto loan with a $14,800 remaining balance at 7.9%, and a credit card with an average revolving balance of $3,200 at 22.7% APR, which she pays down every few months but which seems to creep back up. She has been at this bank for 11 years and has never seriously evaluated the relationship because everything works, everything is linked, and the app is genuinely well designed. Here is what Angela's loyalty is costing her annually in ways she has never calculated. The $22,000 in her savings account earning 0.46% is generating $101 per year in interest. A high-yield savings account at a FDIC-insured online institution, same deposit insurance, same protections, same federal backstop, is earning 4.1% in early 2026. That is $902 per year on the same $22,000. The gap is $801 annually for doing nothing other than moving the account. Her auto loan at 7.9% could have been financed through a credit union, which operates as a not-for-profit cooperative and passes its margin back to members, at approximately 5.4% for the same credit profile. On a $20,000 original loan over 60 months, that rate difference represents $1,140 in total extra interest paid to the bank versus the credit union. Her credit card at 22.7%. The bank's own card, the one they recommended when she opened her checking account a decade ago, is currently charging her approximately $726 per year in interest on her average revolving balance. A balance transfer to a card with a 0% introductory period, available from multiple issuers to someone with Angela's credit profile, eliminates that cost entirely for 15 to 21 months. The combined annual cost of Angela's banking loyalty, the savings rate gap, the loan rate premium, the credit card interest, is approximately $2,667 per year. Over her remaining working life of 27 years, assuming she invests that $2,667 annually at 8% returns, the cost of staying in an unconsidered banking relationship is $271,000. Not because anything dramatic happened, because nothing was ever examined. This is where the psychology of the relationship becomes the product. Banks invest extensively in what the industry calls relationship stickiness, the set of emotional and logistical factors that make customers reluctant to leave, regardless of whether the financial terms justify staying. The birthday email is relationship stickiness. The teller who has known you for 8 years is relationship stickiness. The app with 12 months of transaction history you would lose by switching is relationship stickiness. The direct deposit requirement that qualifies you for fee waivers is relationship stickiness. It is a financial leash dressed as a benefit. The platinum preferred status on your checking account with benefits you have never audited is relationship stickiness. None of these things are accidents. They are retention infrastructure, and they are enormously effective. A 2025 J.D. Power survey found that 78% of bank customers who reported being dissatisfied with their bank's fee structure still had not switched institutions within the prior 12 months. Dissatisfaction without action is exactly the operating condition banks are designed to maintain. The question I keep coming back to when I look at this data is whether the people staying in underperforming banking relationships genuinely don't know there is a measurable cost, or whether they know and the switching friction feels larger than the financial penalty. What do you think is the bigger barrier, the knowledge gap or the effort gap? Because the answer to that question changes what the solution actually needs to look like. The operating model that turns this around is not complicated, but it does require that you stop thinking about your bank as a relationship and start thinking about it as a vendor you are evaluating on price and performance, like any other service provider. The first structural move is to separate your transactional checking from your savings entirely. Your checking account should hold 30 to 45 days of operating expenses, enough to buffer timing gaps between income and bills, and nothing more. Excess cash sitting in a checking account earns nothing and exists only as a reservoir for your bank to hold cheaply. Move everything above your operating buffer to a high-yield savings account at a separate institution. The top FDIC-insured online banks, including Ally, Marcus by Goldman Sachs, and several others, are consistently paying 3.8 to 4.5% APY with no minimum balances and no monthly fees. The transfer takes 1 business day. The paperwork takes 20 minutes. The annual return on a $25,000 emergency fund at 4.2% versus 0.46% is $935 per year. The second move is to price every loan product at multiple institutions before accepting the first offer. Your primary bank should be one of 3 to 4 quotes you collect, not the default. Credit unions, which are member-owned nonprofits with a legal obligation to return earnings to members in the form of lower rates, consistently offer auto loan rates, personal loan rates, and mortgage rates that undercut traditional banks by 0.5 to 2.5 percentage points, depending on the product and your credit profile. The National Credit Union Administration has a locator tool at mycreditunion.gov that identifies federally insured credit unions in your area that you are eligible to join. Most Americans qualify for at least 3 to 5 credit unions based on employer, geography, or association membership. The application process is structurally identical to opening a bank account. The rate difference over the life of an auto loan or mortgage is measured in thousands to tens of thousands of dollars. The third move is to audit your credit card portfolio once per year with one simple question. Am I carrying any revolving balance? And if so, what APR am I paying on it? If the answer is yes and the rate is above 15%, that balance is the highest return investment opportunity available to you at this moment, because paying it off produces a guaranteed, risk-free return equal to the interest rate. A 22% APR credit card balance eliminated is equivalent to a 22% guaranteed annual return on that capital. There is no index fund, no real estate investment, no alternative asset that reliably produces that outcome. Pay it off. If the balance is too large to eliminate immediately, do a balance transfer to a 0% introductory card, set the payoff on autopay, and eliminate it within the promotional window. The fourth and most overlooked move is to calculate your net interest position with your primary bank once per year. Add up all the interest you paid across all products, mortgage, auto loan, credit card, personal loan, and subtract all the interest you received across all deposit products. That net figure is your annual subsidy to your bank's earnings. If that number is above $1,500, you are almost certainly not using the most competitive products available to your credit profile. And the difference invested at 8% over 20 years is likely above $150,000. Run the number. Let the number make the decision. The broader truth is that the banking system in its current form is not a neutral utility any more than a grocery chain is a neutral utility. It is a profit-maximizing business operating in a highly competitive market that has also figured out how to make competition feel like disloyalty and evaluation feel like effort. The customers who navigate it well are not cynical or paranoid. They are simply operating with a clear-eyed understanding that the institution holding their money is not their friend, or their advisor, or their partner. It is a vendor. And the discipline of treating it like one, comparing prices, switching when the terms are wrong, refusing to pay for inertia, is worth more in lifetime wealth accumulation than almost any investment strategy a person could spend the same amount of time optimizing. Daniel in Charlotte is going to open his banking app tonight the same way he opened it last night. He is going to see a checking balance, a savings balance, a loan balance, and an equity line balance, all in one clean interface, all connected, all convenient. He is going to feel the way the app was designed to make him feel, organized, in control, financially settled. None of those feelings will be wrong exactly, but somewhere between the interface and the reality, the $11,400 annual transfer from his working life to his bank's quarterly earnings will continue its quiet transit, unexamined, uncontested, entirely legal, and almost entirely